Good afternoon, everybody. Welcome to Selecting an Option Strategies webcast. I'm Connie Hill. Happy that you have joined me here today. Last week, we talked about maybe using some technical indicators to help us identify if we were in bearish ranges. Now, I bet you probably have identified that as the case. So my question to you today is, do you feel like you still need some protective strategies? Okay. That's my question. Feel free, answer that in the chat. And that's going to be our first topic that we get into here today. Now, I'm joined in the chat by Cameron May. So glad Cameron's here. He's a fellow coach and friend. He will help me pick up some questions that maybe I can't quite get to, or maybe a little bit off topic, but we encourage you to stay on topic. And as you have questions, let us know, because we want to help you out. So happy that he's here. I hope you're following both of us on X. I'm Connie Hill CS. He is Cameron May CS, and we'll post educational content. You know, we'll post things that we notice about the markets or charts. I tend to post a lot of charts, and it's just little nuggets, little tidbits you can get free throughout the trading day. So if you have an X account, you might want to just give us a follow. Now, let's go through some disclosures, and then we will get down to our agenda today, and it's pretty packed full in terms of what I have planned. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and education only. Don't consider it a recommendation. We're going to be using the Paper Money software application. It's for educational purposes only. I think it's a fantastic tool for you to use as you're learning new strategies. With long options, investors may lose 100% of invested funds. Past performance of any security or strategy does not guarantee future results or success. Important note here, short options can be assigned at any time after expiration, regardless of the in-the-money amount. That's something a Paper Money account doesn't do to you. It won't assign you early, but the live market definitely can. So I like to point out that difference to you. All right. This weekend, I hope you're going to be in Detroit. If you're anywhere near Detroit, go. You will love it. A couple weeks after that, first part of May, Denver, and then Anaheim. So a little bit not on the East Coast right now. So come join us on the West Coast. Or Denver's not really on the coast, but out in the West for our technical analysis workshop. That's usually day one. Option strategies is day 2. You don't have to attend both, but if you think you're interested, sign up now before they fill up, because they really do fill up pretty quickly. So we like to let you know, give you a heads up on it. All right. In our class, we always want to look at what is going on with the market conditions. Kind of discuss that and see how that might influence us as far as what strategies that we might trade. And of course, we're going to look at a lot of examples. At the beginning, a question I asked you was, do you feel like you still need to be in some protective strategies? Had a little bit of a bounce in the market today, but then it lost it, and then it looked like it was going to go up again. Then it lost it. Looked like there was a little rally at the end of the day. We'll take a look at that. So first of all, let's go over to my Thinkorswim. We'll start out there. And I have the VIX up to begin with. Okay, volatility, giving us an idea. This is just this is maybe only a 6-month chart here. This is a 6-month chart. No, it's a 1-year chart, but I do need to zoom out here a little bit. Okay, that's a little bit better perspective. You know, we really haven't hit high extreme volatility ranges until this week and the end of last week. Okay, this day here that was August 6th. That was the day that there was that carry trade that was unwinding that impacted global markets, and volatility spiked on that day and then dropped back down. And it really hasn't been there, right? For the rest since August, hasn't been there until last week. So, 30 is kind of a high range of volatility, or on the VIX, that reading. But it spiked up, even getting up to the 60 range, okay, for a day, and then it dropped down. But overall, I'd say we're still in pretty volatile circumstances. If we pull up the SPX, and like I said, it was kind of all over the place today. I posted this out on X earlier, and what I want people to come away with here is knowing that this line is a very long-term support line. Let me show you that. Let's go out to a 5-year chart. Oh, I even got to go a little bit longer. I think we need a 10-year chart. There we go. And this is just a very long-term diagonal support here. And really, that's where the market's dropped to. Okay, a very old area of support there. But within that area of support, what I was demonstrating today is we still have a flag pattern here that's bearish. We have the drop. Today, we kind of had some consolidation in the flag, maybe a little bit yesterday, part of the day there as well. And earlier today, it looked like it was even, it was trying to break out of this flag to the top direction, but it just couldn't sustain any type of a rally. I was watching it really closely the last hour of the day, and man, it was all over the place. So if you're feeling a little bit whipsawed a little bit, it's very understandable because, yeah, the market is just very volatile right now. And there could be some of you that say, given those conditions, I'm just going to step aside right now. Nobody has to force me to do any trading. Only do trading that you're comfortable with, okay? But don't feel like you're obligated to do anything because obviously you're not, okay? What would we look for tomorrow? Now, I would look for seeing if we maybe break out of this consolidating flag range in a meaningful way and close there, okay? Some might be concerned about hitting this long-term area support. So some might even wait for it to break lower than that before pursuing additional bearish strategies. Now, the NDX looks fairly similar to this. I didn't draw the flag in, but if I were drawing, I'd probably draw something in the range of where that gap started down to the low of yesterday. And then today, that was a pretty tall candle. On a flag, we don't want the area of consolidation to go more than 3/4 of the way up the flagpole. And I'm going to say it's, where it got to here earlier today wasn't quite to 3/4, but if it were to make a move up tomorrow, it might be considered more of a full retracement and not necessarily a flag pattern anymore. Okay, so those are the kind of things we're looking for on the SPS as well as the NDX. All right. Now I'm going to just check comments here because I wanted to know if anybody still felt like we needed to be concerned about protective strategies. Greg said, well, I always need protective strategies. Greg, I love that. That is perfect. Yeah, we always want to be not complacent, right? That we're kind of a little bit defensive in terms of what we're looking for. So I appreciate that comment. Let's see. The market is wonky, says Ricebird. Wonky, perhaps. All right. My biggest adjective for it is volatile. And you can see down here on the implied volatility how much it spiked here the last week with that big drop off. So what does that mean for option premiums? Since we're in option strategies, much more expensive, right? Because the market makers have to account for that volatility, and so they put it in the option. So that means really expensive options. For traders, that might help guide some of the strategies that they might look at. Now we're going to head back here and look at some of our different strategies that we might consider using. Well, we're obviously not in a bullish market here, right? So probably not doing a whole lot of anything in that first column. Some of you might feel like we might be a little bit neutral, or you might be looking at some stocks that are a little bit neutral. And so you might say an iron condor trade. I like something that Cameron May did earlier today. He was teaching getting started with options, and he talked about a long call and a long put together, which is something that we call a straddle or a strangle, depending on what strike prices we use. And quite honestly, with the kind of movement we're seeing in the market, that very well could be a possibility, with the idea that you're just looking very short term on things. Brent Moores also taught a class earlier today, right after Cameron did, about long options. And he put out there a strategy of just taking profits on these small little moves. Maybe the moves occur very quickly. It's not necessarily a day trading strategy per se, because we don't really focus on that, but something a little bit more short term. Now, in terms of protective strategies, somebody could consider doing something like, I'm just going to say a long put. It doesn't necessarily have to be a vertical. that kind of long put would be up here. And some people might use that as a protection strategy. We don't really do any stocks in our class, but I wanted to put us in the scenario of saying, okay, what if we did have some stock? What if it was a longer term holding? What if we were concerned what we were seeing in the market? What could we do? Yes, we could buy a protective put. We could also sell a call against the stock. Just selling the call makes it a covered call strategy. But when you put both of these two together, buy a long put, sell a short call, does a couple of things for you. One, it basically is two bearish strategies. So you wouldn't want to do it if you were maybe just a tiny bit bearish. But if you felt like, it's quite bearish out there, I need to have some protection. So come with me as we look at an example here today. And Cameron, thank you for posting that out in the chat. I'm going to guess that is either Brent's lesson. That's what you said, Brent's lesson out there in your lesson. Perfect. Some great content here today, guys. Let's jump over here back to our Thinkorswim here for just a moment. And what I did earlier today is I bought some stocks for us. Actually, I just bought one stock. This Netflix is a little old from another class that I substituted in. And what I did today is I bought this AGI, 200 shares of it. And it looks like we're down a little bit here. I want to show you what the chart looks like. This is one of the very few stocks that actually has been a little bit bullish. It's a gold stock. You can see this Anna Gold, Ashanti. And I do believe, let's look at this real quick on the fundamentals. I was thinking it might be a foreign stock. And it's not. It's in my neighborhood. Actually, not my neighborhood, but my neighboring state, Colorado. Okay. But it is a gold stock. Okay. What have we been seeing with gold? Well, it's pulled back a little bit the last few days, but overall, what did we have last week? We were seeing all-time highs again, right? We don't trade futures, but if you're trying to stay on top of what is going on with the gold futures, you can see here what day was that. That was just the 2nd of April, so that was last Wednesday, hit an all-time high in those gold future contracts. And so many gold stocks, gold mining stocks, many times have some correlation to what's going on with gold. So what we looked at here is I was seeing the stock pulling back, and then earlier today it looked like maybe it was bouncing off this 30-period moving average. It also at one point looked like, didn't close there, but looked like it was going to move past the high of this low candle day in the pullback. It didn't quite do that, but for purposes of us being able to do a collar, I wanted to have that stock in there. Okay, so we're going to go through the scenario that even though it is in a bullish trend, where you still are concerned about protection. And when we're talking protection, you might want to have an idea in time for, well, how long do I need protection? Do I need it just to go over an earnings period? Do I need it for a longer period of time? Because you're going to choose what period of time you're going to need here. Now, this stock's traded 2.5 million today. It doesn't have weeklies, so we're going to be limited to the monthlies. So if it was like, say, having earnings tomorrow and you just wanted to protect over earnings, maybe you do the April 17s. If you're looking for a little bit more time than that you need protection, you might come out here to May. And if you were really looking for a longer period of time, say you really felt like things were going to continue, you needed protection into the summer, then you could go a little bit further out. For our purposes here today, we're just going to use these May contracts. Now, one thing that I'm really high on is making sure we've got enough open interest. Okay, so here's the open interest column. So we got a little bit of activity here, a little bit more activity over here on the put side. So if you were saying, maybe just a little bit of protection, you might consider selling a call. You could sell a call at the money or even out of the money. You could also say, well, I think maybe it'll go down. I want something to offset the price of the stock dropping. And so we know of puts, if the stock drops, they're going to gain in value. So you could go the other way and say, well, maybe I'll buy a long put, or we could do a combination of the two, which is where we're going here today. So the stock closed at 33.16. So the 33 strike prices are at the money. that's the one that we're going to work with. And as we do so, it's a little bit wider here than it was earlier today. Earlier today was about a 20-cent spread. This is more like a 30-cent spread. But what we're going to do here, I'm going to hold down my control key and we're going to select on the bid price for that 33 call. We're going to select on the ask price for the 33 put. And as we put those two together, it's just going to take the difference of those. And they're really fairly close to each other. In this case, it's going to bring us back with a little bit of a credit. Now, what's going to happen if this stock drops? How's that going to be benefited? Well, the call, is that going to be useful? Yeah, it's going to be. I want to show you kind of how you could do a what if using the theoretical, the Theo price calculator. So I'm actually going to come in here and reset it. And in order for this little calculator to come up, that allows us to put in theoretical scenarios, like what if the stock does this by this date, and maybe implied volatility does this, what are you looking at? Okay, so you have to choose in your columns, you have to choose Theo price. Okay, so in my set of columns, I've got a Theo price right here. It's just one of the columns that you can select to go with any combination of columns that you're interested in. This is one that it's pretty similar that I like to keep up for lots of option strategies because it has my delta, which we use a lot, open interest, make sure there's other contracts out there. Sometimes volume that happened today can be helpful in certain situations. Probability of expiring out of the money. So this is the OTM. And then here's our Theo price on the call side over here on the put side. So how much do we think maybe it could, drop? Right here, kind of around the 30, it has seemed to find some support there, okay? But what if you were concerned, with whatever's going on in the market, it might drag it down too. So let's suppose you thought maybe it would drop $1.50 over the next week, okay? Let's plug that in. If indeed the market did that. So we click on our calculator and we're going to say, all right, let's say if the price goes down $1.50, and here's the date so we can accommodate for time decay. It's got today's date in there. What if we really we would not be putting on the collar until tomorrow because market's closed right now. What if we said give it a week? Okay, let's come out here. Let's go to the 15th. We'll go for a week from today. That'll give it 5 full days. And then let me put the stock price in again, down 1.5. I'm not sure what happened to my little one. And then if you think implied volatility might go up, might go down, you could adjust for it. And you could put it down here in this area. If you think implied volatility is likely to drop, okay, you put in a minus and whatever you think that percent might be. Now I have it plugged in on the chart so we can kind of see what's happened here just recently. So when this was up here, kind of the day of its all-time high, looks like implied volatility was at about 0.42. At least that's where it closed. And then in the days when it ramped up here, it went to 0.59. So about 15 percentage points of volatility is what it spiked up between that low and the high. And then right now we can see it sitting at about 5.6. If you don't know, if you're like, I have no idea if I think it's going to go up or down, maybe just leave the equation alone. Don't put anything in there. If you think, oh man, if we have another step down, yeah, in 3 or 4 days, that could pop up another 15%, then you could go ahead and put that in the calculator. Now I have a question for you. How many of you currently use the Theo price calculator? I'm curious. Go ahead and chat into me if that is something that you've been using. So in our scenario that we plugged into the calculator, we put in next week's date. Oh, that's going to be tax deadline day. Down $1.50, and we're not going to do anything with implied volatility right now. But our option that we're basically going to collect 245, maybe a little better if it gets a midpoint price, and buy for about 240 or a little bit better, giving us a midpoint price, which is why we're kind of ending up with a credit here. then what we'd do is would say, well, what is the value difference in our call and in our put? So I'm just going to put in our call, and I'm going to use the straight natural price. Okay, so the call, the premium that we brought in, we'll say is $2.45. And what would it be worth? Approximately $1.62. Now, does that benefit us or not? Absolutely, it does. We brought in the $1.45 initially, or the $2.45, I should say. And now the price of that option's down. We love to see that, right? That's melting time decay, giving us an opportunity to start locking in some profits with what we already collected. Because really, a trade's not over. When you've sold an option, it's really not over till it either expires, it gets exercised, or it expires. It could, or you get out of the trade. I did expires first. Yeah, or you decide to close it, whether you're up or down on it. Now, what about the put? We're going to say the put cost about $2.40. And so with that move, it looks like maybe, and these are not cut in stone, these are not absolutes, okay, about $2.81. So on the put, let's go $2.40 to $2.81. So just with some quick math, we can see on the put side, we're gaining what, about 39 cents-ish, okay? And on this one, let's use the calculator here, $2.45 minus, let's see, $2.45 minus, what did I write down there? 162. So the change in that price, actually we gain a lot more on the sold call than we do on the long put. But then that can help offset whatever we've missed in terms of the stock price. Now, does it always totally offset it? Not necessarily, okay? Let me put in our 83 cents there. Because if we were down $1.50 on the stock, let's just suppose our cost basis is what we're seeing up here, okay? And it goes down $1.50, 33.16 minus $1.50, because that's what we put in the Theo price calculator, puts possibly the value of the stock from 33.16 down to 31.66. Okay, that's $1.50. Now this doesn't meet up exactly with $1.50, right? 83 cents plus the 39 cents, which is basically what we've gained out of each position. But you can look at that and go, you know, that's a good chunk of it. And that's kind of what I want you to see, is that it's not a perfect hedge that's dollar for dollar, you know, going to work out exactly, but it's the idea of, you know, we have a 45 delta option and a $55 or 55 delta and a 45 delta, which sum to 1 delta. And we're getting some of that, a good chunk of that price action. Okay. All right, Greg, I was asking if you've used the theoretical calculator. So Rice is saying you've used it a couple of times before. This might not be something you do every single day, but when you're maybe trying to understand strategies, how they could benefit you, it definitely comes into play there. Greg says you're not familiar with it. That's all right. That's okay. Rice says, we make it look so easy when we show it. After you play with it, experiment with it, and that could be something you might want to do this week, is experiment with it so that you do get comfortable, so that you too will click on it and go, boom, price, boom, implied volatility, boom, let's go a week out or whatever time frame you're kind of looking at, okay? So that you do get more comfortable with it, all right? So this is not to make you think that it's going to be super easy the first time you ever see it, but giving you this exposure and then you going back and practicing a little bit certainly will help you. Andrew, you haven't used it a lot either. Okay, this is good. Let's add up our 83 cents. Let's see if it'll take this. Let's go 0.83 plus 0.39. That gives us $1.22. So the stock, we lost $1.50 on the stock, but this is how much $1.22 that in that scenario would have helped us out. Now, what if implied volatility would have increased? Oh, we're going to have some different numbers here, right? We come back to the calculator and say, okay, what if this extra element, what if implied volatility goes up another, let's just go 10%, okay? So I'm going to put in here plus 10%. If you think maybe it would drop 10%, you know, put a little minus in there at dropping. And then we can see, yeah, the values of those options changed a little bit. Instead of being, let's see, what was this here? 281. Looks like if implied volatility were to go up, then the value of that option would increase as well to 318. And on our Theo price here, or this option, I'm just going to kind of click it out of the way here, then the new Theo price here is 198, and it had been 240. Well, that's allowing us to capture, well, actually not in that case. It's actually going the opposite direction on the short option. But you kind of get the idea of how that works. Possibly what we received on the put end could offset the additional implied volatility price. That maybe it doesn't melt quite as much for that portion. All right. Any questions on the theoretical price calculator? Or any questions on structuring a collar? Okay, for those of you that maybe came in a little bit later, what we're doing here, we're basically saying we're selling a call at whatever the at the money is, 33, and buying a long put, and those are two bearish positions. Now, what if gold totally stabilizes and this stock goes up? We can just run the opposite scenario, right? You could come in here to the calculator and say, oh, okay, let's suppose it went up $1.50. Okay, so plus $1.50, and maybe we'd clear out the volatility. Then you can go through and kind of do your what if scenario if it goes the other way. And I think that helps you visualize, you know, how a collar could assist if you do own stock. And like I said, it's not something we've talked about a lot in this class because we really don't have stock positions. But I think it's an option strategy to really concern yourself with as we're seeing what's going on in the market. Okay, so David says you use it maybe on 1 out of 10 trades. Awesome. You're finding some place where it might help you. And that's fantastic. Not, or you can use every single tool on every single trade. Now, I do want to put in some new positions. Okay, we're going to go with the idea that because of what we're seeing in the market, that still lots of bearishness, maybe it'll drop down through that bear flag, we'll see tomorrow. But we're going to be looking for some bearish strategies. If somebody was very directional, maybe you'd do long put verticals. If you're looking at, man, those are just expensive premiums, let's sell the heck out of it, then you might look at short call verticals. And so the ones I've got lined up here actually are, most of them are short call verticals. Let's look at, you know what, I have to tell you something real quick, guys. Oh, everything we talked through as far as strategically is legitimate. I typed in the wrong ticker symbol. We actually have AGI, and I typed in AU. So let's look at AGI for just a minute. You know how the calculator works. You know what could happen. I want you to see there is a lot more open interest out here, lots of activity. That means that's probably why the bid-ask spread was a lot narrower when I was looking at it earlier, is because I was looking at this and not AU. Okay, so I apologize, sticking the wrong ticker symbol in there. But I think everything we talked about applies to whatever you might consider for that stock. Okay, AGI in this case. All right. Actually, let's go back to the chart here, and I'm going to pull up one here. APTV. Let's take a look at this. Whoa. This is a technology stock. And maybe let's give us about 6 months here rather than the 3, because I've drawn, what have I drawn in there? I've drawn a Fibonacci. And what I had done some time ago is I had kind of priced out this move using the Fibonacci. And really what you do, you pick a high point of a move and the low point of the move, and you would draw your Fibonacci on there. I'm going to remove it, okay? And I'm going to redraw it here. I'm just going to select on my little icon on the toolbar that's the Fibonacci. If you are bearish and you're looking for maybe extensions down on the price, we start at the top. So we start at a top move. And then what we're going to do is we're just going to draw it down to here, to where the low was here, okay? So we're going to start at the top. We're going to move that little guy right as close to the bottom as we can do, okay? And what was interesting, or I found interesting here, having drawn this a while ago, look where it stopped. Sometimes on these Fibonacci's, these ratios, when you use them, basically it's a repeating pattern that we're seeing. And many of these repeated patterns can be found on stock charts. They're found on our thumbnails, they're found on thumbnails and sunflowers, what I wanted to say. They're all over in nature, okay? And these ratios appear in stock charts as well. And so, interestingly enough, kind of the last 3 days, it's been back down here to that low. And so, if we're going to expect some movement, I drew that upside down, didn't I? Let me redraw this. I needed to start it at the bottom because I'm looking for lower. So let me just redraw it going the opposite way. Because then that's where we see where possibly the next point for it to identify some support could come into play. Now, what's interesting here is this green line is some support drawn way back, okay? And it's kind of close in that area. So we might say, yeah, maybe in this general area might be a support level from the past as well as with Fibonacci. Now, you could use Fibonacci's to help you identify targets, right? And some might say, well, did this really break through here today? Yesterday is just kind of hanging there, maybe bouncing. The day before it went down through it, but then ran back up. But today definitely is a close below it, okay? So some people might use that as an entry point to a bearish trade. So we are going to bring up here APTV. It only has monthly options. April's a little bit short, only 9 days left. A lot of traders like to sell between 20 to 40 days worth of time. Sometimes you got to get up to 50. This is kind of right in that sweet spot at 38. So let's see if what I was anticipating still looks pretty good. I was looking to sell the 55 call and buy the 57.50 as our hedge leg. And there's enough open interest here if we're just doing, you know, a handful of contracts here. But clearly some are going to be more liquid than others. If you were somebody that said, you know, I kind of want to be more directional on it, maybe you might be interested in the puts. The concern I might have with the puts is that, you know, somebody might use kind of that at the money 50, and then if they only hedge or they only go out $2.50, there's not a lot of open interest here. 19 contracts and 4 today. They could spread it out a little bit wider. 73 contracts, not a ton. Okay, so that would be the concern. So if that's one of your parameters, you go, okay, I'm not gonna do a long vertical because there's not enough open interest on the put side of things. And so then you might shift over to the call side of things. Okay, so we are gonna do this. We are going to do a 34 delta. We're going to say sell vertical, and we can just do, you know, sometimes my mouse gets a little tricky and it likes to run up to buy when I'm telling it sell. And market's closed now, so this number should stay put a little bit. Our max credit on it is 72 cents. And if we take 250 minus our 72 cents, that's going to give us our max theoretical loss. Okay, so I'm going to kind of clean up this area. We don't need that anymore. We've shown you how to use that. And so basically $1.78 would be our max loss. Our max theoretical gain should be $72. Next step, what do we typically do? We're going to see if that gives us a good enough return that we're good with it, right? That it makes it worth the while. Now, many times people will sell a 30-something delta Sometimes they might sell a 40-something delta if they want maybe a higher return and a lower probability of success. Right now, this one, it has a probability of expiring out of the money at 72+%. So generally, people consider 60 or higher to be high probability. So definitely higher than that 60%. But let's see what it gives us. We have max gain divided by max loss, $1.78. That gives us about a 40% return. That's acceptable to us. If somebody wanted to go further out of the money, you bring in a lower credit, which is fine. Just run those numbers. Make sure you're comfortable with the kind of return that you might be getting there. All right, so this one would be in the neighborhood of about, I'm just going to put 40%. All right, 178 is our theoretical max loss, and in our class, we can risk up to $1,500. Now, that means you don't have to do that in every trade. You might say, oh, I'm a little concerned about the market right now. Maybe you don't take on a full position. Maybe you start out with half of a position. Maybe you only risk $750, okay? For our purposes today, we're gonna go ahead and use that $1,500. We're gonna divide that by 178, because that's our max theoretical loss per contract. That says we can do 8 contracts. So we're going to plug it in. We're going to do our 8 contracts here. First, trigger sequential. We're going to buy it back. We're going to put in an exit order. And we're going to put this in. If we get 70% out, we're happy. If we get 70%, only 30% is left. So let's multiply 0.3 times our credit of 72 cents. We're going to buy it back at 21 cents. 0.21. All right, going to make this good till canceled. And it's amazing how often you'll actually get filled at that. I'm going to show you a couple of our trades that executed for us from last week, and kind of is a little bit eye-opening when we take a look at it. Let's go ahead and put this one through to our option strategies bucket. I'll make sure that gets filled tomorrow morning. All right. Next one. Let's look at this. Let's go to, I like this one a little bit better. Let's go with AMD. Semiconductor stock. We used it in a different class for a trade that I'll show you had the results on that on Thursday. This was one, though, we put in the trade this day and it executed for us the next day. Okay, it was like boom, boom. What's it looking like right now? You're like, well, Connie, maybe it's sitting there at a support area. It could be. It wasn't down quite that far. Let's see how low that is. Looks like maybe we'd have to go back. I think I had to go back a couple of years to see that one. It's not going back that far. Okay, let's go 5 years. Okay. I went back on a 5-year chart to see, okay, where are the layers of support that it could drop to? Okay. And so there's this area here at 90, like 94-ish. Okay. Another area here, old resistance, new support around 77 and some change. Okay. And even if it drops lower, you know, maybe it's down there at 61. So there are some levels of support, but it hasn't been there in a long time. The one thing I'm thinking on this one, let's go back to a daily chart, is we have a bearish engulfing candle today. We have a bearish engulfing candle, and we've got 3 days up here about 89, and we have a bearish candle at what maybe is considered short-term resistance. Then some people might use that as an entry into a trade, because you can see this big old candle here is totally eclipsing yesterday's little bit of bullish candle. Okay, so that is what we're going to use for entry. Now, some people might say, well, make sure it goes below 77.66 first. And that could be something that some of you might consider. Let's bring up our AMD here. On AMD, they do have some weeklies. And on here, I was maybe considering doing the May 2s. May 2s give us 24 days. And AMD has quite a bit of open interest. And again, looking at a short call vertical. Now, as we look at this, we're going to kind of come out here to the 30s. We've got lots of choices here. Let's see if this still looks good. I was looking to do 89.90, and 89 is right here, about a 29 delta. Let's see if that would give us enough of a return. We know implied volatility is high, so that means maybe we can choose a little bit of a lower delta, still get the kind of return we're looking for. So on this one, we're going to go what? 0.29, our max theoretical gain, divided by, what's that going to be, 71? 0.71, about a 40% return. Okay, now if you did want to say, hey, go and break down below that support level and then get in, you could do that. Just set up your conditions over here. We're not going to do that, but what we're going to go ahead and just put it in to get filled tomorrow. Now, in the interest of time, I will position size this and put it in after our class is over because I really want to show you what happened on a couple of our trades. Okay, so that's going to be the second trade that's going to go in for today. So first stock we're going to look at J. All right, J&J, we just put in last week. We had seen bearishness. The day we looked at it was this day, April 1st, and then our order went in the next day. Well, the very next day it went against us, but then nice little pullback. And what happened? This is not that many days later, 1, 2, 3 candles later, it hit our target that we put in there, which was about 70% of the max gain. All right, so great. This one is unusual. This is not very common to see. Just take a look at the chart here. And notice I've got a green and a yellow on the same candle. So green's the entry, yellow is the exit with a profit. And if we come over here to the monitor tab and account statement, that was our J&J's MRK Merck. And what you're going to see here, trade history, it went in at 7:32 and 38 hundredths of a second. We got filled at 31 cents. We had our order in here that we wanted to get out at 7 cents. So sure enough, the next second, boom, we got filled. It went and bought it back. So super short trade. I do want to stress that's not very common, but if you have an order in for the market to execute it for you, and if they can, it can happen. Sometimes people will put market orders in, and so a market order, when it comes in, the market fills it whatever's available next. So sometimes that might be great for that person. Sometimes it might not be. All right. In our case, it worked out beneficial, but don't count on that happening a lot. But it was something that happened here on our example trade for last week. All right. Any questions on anything that we've talked about here today? If so, now is the time to speak up or forever hold your peace. No, we won't say forever hold your peace, but I do hope you are a subscriber to our Trader Talks channel, okay? When you are, man, it helps you find our content really easily. So select on the little blue YouTube logo down on the bottom right of your screen. That subscribes you, but just click it once. If you click it twice, then it will unsubscribe you. But when you are a subscriber, you get to see this view that shows you, gee, what might be coming up next. This is before our class started here. Some videos, some classes that have taken place recently that you might be interested in, some of our most popular. And then I'm going to point something out to you here that are a couple of short videos I did just recently that some of you might be interested in. One is just quickly how to create your own groups on the monitor tab. And then this one is how to use what's called the new walk limit orders. Okay, that's a new order type. Those of you coming over from Schwab have been, man, you have been waiting for that to appear. So I wanted to let you know that it is here. Okay, so you can check out those two videos. Now, it does look like we have a survey, which I didn't notice earlier. We do have a survey out in the chat. And so for those of you that haven't seen that survey before, it's really quick. You just fill in 2 radio buttons, plop, plop. And then if you want, you can answer questions. And I always encourage you as well, if you want to communicate something else to me that doesn't really answer the question, feel free to do so, because I like to take your comments, things that you're interested in, maybe things that you're struggling with, and incorporate those into my upcoming webcasts. Okay, so I will read every single thing that you write down if you fill that out. And as coaches, we really appreciate when you take the time to do that. So I'm going to give you a thank you in advance. If this was helpful to you today, hit the thumbs up on the way out as well. That lets other people find the content that you found useful as well. All right, this is the last session of the day. So tomorrow morning, right at the opening bell, we'll be back with Trader Talks. And we will see you tomorrow morning. Cameron, thank you for your help. Thank you, you guys. You've been a great class. Bye-bye.